Here is a quick recap of what we learned in the part 1. It makes sense to be a buyer of a call option when you expect the underlying price to increase. If the underlying price remains flat or goes down, then the buyer of the call option loses money. The money the buyer of the call option would lose is equivalent to the premium, agreement fees the buyer pays to the seller, writer of the call option. The stock in consideration is Bajaj Auto Limited. For various reasons the stock has been beaten down in the market, so much so that the stock is trading at its 52-week low price. I believe there could be an opportunity to initiate a trade here. Here are my thoughts with respect to this trade. Bajaj Auto is a quality fundamental stock. The stock has been beaten down so heavily, makes me believe this could be the market's overreaction to volatility in Bajaj Auto's business cycle. I expect the stock price to stop falling sometime soon and eventually rise. However, I do not want to buy the stock for delivery yet, as I'm worried about a further decline of the stock. Extending the above point, the worry of M2M losses prevents me from buying Bajaj Auto's futures as well. At the same time, I don't want to miss an opportunity of a sharp reversal in the stock price. As per my estimate, the probability of the loss is low, but nevertheless the probability still exists. So what should I do? Now, if you realize I'm in a similar dilemma that was Anand was in, recall the Anand Balu example from part 1. A circumstance such as this builds up for a classic case of an options trade. In the context of my dilemma, clearly buying a call option on Bajaj Auto makes sense for reasons I will explain shortly. Here is a snapshot of Bajaj Auto's option chain. As we can see, the stock is trading at 2026 rupees and 90 paise, highlighted in blue. I will choose to buy 2050 strike call option by paying a premium of 6 rupees and 35 paise, highlighted in red box and red arrow. The process of strike price selection is a vast topic on its own. We will eventually get there in this module, but for now let us just believe 2050 is the right strike price to trade. So what happens to the call option now, considering the expiry is 15 days away? Well, broadly speaking, there are 3 possible scenarios which I suppose you are familiar with by now. Scenario 1, the stock price goes above the strike price, say 2080. Scenario 2, the stock price goes below the strike price, say 2030. Scenario 3, the stock price stays at 2050. The idea I'm interested in exploring now is this. You will agree there are only 3 broad scenarios under which the price movement of Bajaj Auto can be classified upon expiry, that is, the price either increases, decreases, or stays flat. But what about all the different prices in between? For example, if as per scenario 1, the price is considered to be at 2080, which is above the strike of 2050. What about other strike prices such as 2055, 2060, 2065, 2070, etc.? Can we generalize anything here with respect to the P&L? In scenario 2, the price is considered to be at 2030, which is below the strike of 2050. What about other strike prices such as 2045, 2040, 2035, etc.? Can we generalize anything here with respect to the P&L? What would happen to the P&L at various possible prices of spot upon expiry? I would like to call these points as the possible values of the spot on expiry, and sort of generalize the P&L understanding of the call option. In order to do this, I would like to first talk about, in part and not the full concept, the idea of the intrinsic value of the option upon expiry. The intrinsic value (IV) of the option upon expiry, specifically a call option for now, is defined as the non-negative value which the option buyer is entitled to if he were to exercise the call option. In simple words, ask yourself, assuming you are the buyer of a call option, how much money you would receive upon expiry, if the call option you hold is profitable. Mathematically it is defined as, IV equals spot price minus strike price. So if Bajaj Auto on the day of expiry is trading at 2068, in the spot market, the 2050 call option's intrinsic value would be equals 2068 minus 2050 equals 18. Likewise, if Bajaj Auto is trading at 2025 on the expiry day, the intrinsic value of the option would be equals 2025 minus 2050 equals minus 25. But remember, IV of an option, irrespective of a call or put, is a non-negative number, hence we leave the IV at 2025 equals 0. Now our objective is to keep the idea of intrinsic value of the option in perspective, and to identify how much money I will make at every possible expiry value of Bajaj Auto, and in the process make some generalizations on the call option buyer's P&L. Now, keeping the concept of intrinsic value of an option at the back of our mind, let us work towards building a table which would help us identify how much money I, as the buyer of Bajaj Auto's 2050 call option, would make under the various possible spot value changes of Bajaj Auto in spot market on expiry. Do remember the premium paid for this option is 6 rupees and 35 paise. Irrespective of how the spot value changes, the fact that I have paid 6 rupees and 35 paise remains unchanged. This is the cost that I have incurred in order to buy the 2050 call option. Let us keep this in perspective and work out the P&L table. Please note, the negative sign before the premium paid represents a cash outflow from my trading account. The table above throws out two strong observations. Even if the price of Bajaj Auto goes down below the strike price of 2050, the maximum loss seems to be just 6 rupees and 35 paise. Generalization 1. For a call option buyer, a loss occurs when the spot price moves below the strike price. However, the loss to the call option buyer is restricted to the extent of the premium he has paid. The profit from this call option seems to increase exponentially as and when Bajaj Auto starts to move above the strike price of 2050. Generalization 2. The call option becomes profitable as and when the spot price moves over and above the strike price. The higher the spot price goes from the strike price, the higher the profit. From the above two generalizations, it is fair for us to say that the buyer of the call option has a limited risk and a potential to make an unlimited profit. Here is a general formula that tells you the call option P&L for a given spot price. P&L equals maximum of 0, spot price minus strike price minus premium paid. Going by the above formula, let's evaluate the P&L for a few possible spot values on expiry. At 2023, equals max of 0, 2023 minus 2050 minus 6.35, equals max 0, minus 27 minus 6.35, equals 0 minus 6.35, equals minus 6.35. The answer is in line with generalization 1, loss restricted to the extent of premium paid. At 2072, equals max of 0, 2072 minus 2050 minus 6.35, equals max of 0, plus 22, minus 6.35, equals 22 minus 6.35, equals plus 15.65. The answer is in line with generalization 2, call option gets profitable as and when the spot price moves over and above the strike price. At 2055, equals max of 0, 2055 minus 2050 minus 6.35, equals max of 0, plus 5, minus 6.35, equals 5 minus 6.35, equals minus 1.35. So, here is a tricky situation. The result what we obtained here is against the second generalization. Despite the spot price being above the strike price, the trade is resulting in a loss. Why is this so? Also, if you observe, the loss is much lesser than the maximum loss of 6 rupees and 35 paise, it is in fact just 1 rupee and 35 paise. To understand why this is happening, we should diligently inspect the P&L behavior around the spot value, which is slightly above the strike price 2050 in this case. As you notice from the table above, the buyer suffers a maximum loss, 6 rupees and 35 paise in this case, till the spot price is equal to the strike price. However, when the spot price starts to move above the strike price, the loss starts to minimize. The losses keep getting minimized till a point where the trade neither results in a profit or a loss. This is called the break-even point. The formula to identify the break-even point for any call option is BE equals strike price plus premium paid. For the Bajaj Auto example, the break-even point is equals 2050 plus 6.35 equals 2056.35. In fact, let us find out the P&L at the break-even point equals max of 0. 2056.35 minus 2050 minus 6.35 equals max 0 plus 6.35 minus 6.35 equals plus 6.35 minus 6.35 equals 0. As you can see, at the break-even point we neither make money nor lose money. In other words, if the call option has to be profitable, it not only has to move above the strike price, but it has to move above the break-even point. So far we have understood a few very important features with respect to a call option buyer's payoff. The maximum loss the buyer of a call option experiences is to the extent of the premium paid. The buyer experiences a loss as long as the spot price is below the strike price. The call option buyer has the potential to realize unlimited profits provided the spot price moves higher than the strike price. Though the call option is supposed to make a profit when the spot price moves above the strike price, the call option buyer first needs to recover the premium he has paid. The point at which the call option buyer completely recovers the premium he has paid is called the break-even point. The call option buyer truly starts making a profit only beyond the break-even point, which naturally is above the strike price. Interestingly, all these points can be visualized if we plot the chart of the P&L. Here is the P&L chart of Bajaj Auto's call option trade. From the chart above you can notice the following points which are in line with the discussion we have just had. The loss is restricted to 6 rupees and 35 paise as long as the spot price is trading at any price below the strike of 2050. From 2050 to 2056.35, break-even price, we can see the losses getting minimized. At 2056.35 we can see that there is neither a profit nor a loss. Above 2056.35 the call option starts making money. In fact, the slope of the P&L line clearly indicates that the profits start increasing exponentially as and when the spot value moves away from the strike. Again, from the graph one thing is very evident: a call option buyer has a limited risk but unlimited profit potential. Key takeaways from this chapter. It makes sense to be a buyer of a call option when you expect the underlying price to increase. If the underlying price remains flat or goes down, then the buyer of the call option loses money. The money the buyer of the call option would lose is equivalent to the premium, agreement fees the buyer pays to the seller or writer of the call option. The maximum loss the buyer of a call option experiences is to the extent of the premium paid. The loss is experienced as long as the spot price is below the strike price. The call option buyer has the potential to make unlimited profits provided the spot price moves higher than the strike price. Though the call option is supposed to make a profit when the spot price moves above the strike price, the call option buyer first needs to recover the premium he has paid. The point at which the call option buyer completely recovers the premium he has paid is called the break-even point. The call option buyer truly starts making a profit only beyond the break-even point, which naturally is above the strike price.